So we're going to continue our discussions on investments and how and what they are. So last time we were talking about the term investments. We also we looked into the fact that investments is basically committing money into some kind of an asset where you expect to make a return. Then we moved on to investment objectives, and we looked at the 5 investment objectives that there are for at least for this course, primary and secondary, and we discussed in detail what they were. Then we also talked about some of the investment constraints that people experience, and we looked at the pros and cons of them. So moving on to why study investments. So the issue here is that a lot of people have said in the past that investments are important or finance is important. So some of the reasons why people would study investments or finance is highlighted in this slide. Every one of us will make investment decisions at one point in time. Some of you will be making a decision as to further your education at post-secondary institutions. That in itself is an investment decision. It has not just the money implication of what it costs, but it also has the opportunity cost implication. Opportunity cost simply means what you could have made if you did not do what you were doing. So you could have probably made some money if not going to university, but you choose to go to university, which means you do not make the money that you could have made plus the cost of the education. So that's really the entire investment that you're making. So that's just an example of investment decision. Most people's decisions will revolve around investments such as stocks, bonds, mutual funds, houses, condos, cars, investment properties, and so on. So there's lots of people who make decisions most people will make certain decisions about money at certain points of their life. It's a great idea to start planning for your retirement as well, as early as you can, as quickly as you can, and that means that you will become you will be able to retire much quicker than a lot of other people, and perhaps you will have more financial freedom as well. It is also an essential component of lots and lots of jobs. For example, security analyst. And by the way, the word security means investments. So security does not imply the security that you might think of otherwise. It means investments such as stocks, bonds, and mutual funds. Portfolio manager. So you can be responsible for a set amount of money which is invested in different assets. Investment advisor, which is a very wealthy kind of career that people make. It has lots of opportunity to make money. Traders is another opportunity which a lot of people can think of. Accountants, of course, bankers, fund managers. Fund managers means mutual fund managers. Underwriters, bankers, again, that's obviously a typo. Investment banker. CFA represents Chartered Financial Analyst. In accounting, you have designations that are different for each country. In finance, there's only one designation, which is CFA, which is global. So there are 3 sets of exams for this, and you need certain experience requirement as well. IA stands for Investment Advisor. CFP stands for Certified Financial Planner. Again, this is a global designation rather than a national one. So what kind of decisions imply investment? There's obviously a risk-return trade-off. We're looking at the higher the risk, the higher the potential return. So that is key. That is a key concept in finance. The higher the risk, the higher the potential return. And remember the word potential, because if you're taking risk, there's also a potential of a downfall. So that's why we say the higher the risk, the higher the potential return. What is this concept of risk? Risk is the possibility that the actual return will be different than what was originally expected. So if you expected a return of 5%, the fact that it is different at the end, perhaps 7%, 3%, whatever it is at that point, that is the premium on risk that you have earned because it was expected to be something else. And you can look at this slide, which clearly correlates or presents the risk-return trade-off in a graphical format. And you can see that the line that representing the return is going up, but it does not start off at 0. It starts off at a number, 2, 3, whatever it is. It starts off at that number because that is a risk-free rate, which means that you can put money into the bank account and probably have no risk attached to it, and you will still earn something. So whatever that something is called the risk-free rate. Again, risk-free rates are probably less than inflation. However, at least they're there. It's not 0, it's always a positive number. And then you can see the higher the risk, the higher the potential return. And bonds and stocks are listed there. Now, if you expand that line a bit further, the next slide gives you a few different options of the risk that you can take and potential return that you can make. So you can see at the bottom we have treasury bills, which is still not at 0. It is at probably 1.5, 2%. Treasury bills are investments in the government. So you are basically loaning the government some money for a short period, like a month, 90 days, or 6 months, or so on. Government bonds, again, are a long-term version of treasury bills. So government bonds are 25, 30, 35 years in nature, and they are again something that you're loaning the government money, and the government will be paying you interest. Why do you think it has risk? Because governments can also have default. So for example, very recently the city of Detroit government is going through bankruptcy protection, and others will be probably protecting the city. Other cities will probably come out to help out Detroit. In the past, you've heard of Greenland, Iceland, and also Greece, Ireland. A lot of these countries are near or at bankruptcy as a country. Corporate bonds is the next one that you can see, and then of course you see some shares, real estate, and then shares again. I will differentiate between common and preferred shares later on in the course. And you see different types all the way up to options and futures. Options and futures are derivative types of investments, and they are very, very risky. A lot of times you make some money, but a lot of times you lose everything. So that's the reason they are up there. The next slide goes into the investment decision process. So basically there are 2 steps. One is the analysis process, just like in anything else in life. You analyze, you understand, you look at what you need and where your goals are, what you want to achieve, how you would want to get there. And then there's the portfolio management, and then basically, which means the implementation. So you would actually invest somewhere, you probably get a second opinion, you should review the investments quite often, probably once a year or twice a year. And how do you measure the performance? You have to come up with some kind of indicators. So that's the second step. First is obviously analysis and thinking and reviewing. Second is to actually do it. So those are the 2 steps. They are named investment analysis and portfolio management in finance. Just to highlight at the end some of the professional education alternatives that you can go for if you are interested in going into the world of finance. Finance and accounting, by the way, are very, very correlated. A lot of accountants work in finance. Eventually, a lot of financial analysts sometimes change into the work of accounting. So they are very closely related, and they are very powerful together. If you have an accounting designation and a finance designation, you can probably make lots of good money and earn a lot of respect from your colleagues in the banks or wherever you so choose to work. So in Canada, we've got Canadian Securities Institute, where the Canadian Securities Institute offers certain courses, and what happens is you can then become an investment advisor after these courses are taken. CFP Association is an association of advisors and planners. It is a global association. Canadian Securities Institute is a Canadian institute. CFP Association, you can become a CFP through them, and of course then practice certain parts of financial planning. I think in Canada, if you want to practice financial planning or advising, clients, you have to become an investment advisor through the CSI, but you can obviously have the CFP designation. CFA Association, again, is a global designation. It is really for internal financial analysts, so investment bankers, analysts, corporate investment analysts, and so on, and it leads to the Chartered Financial Analyst designation. It has 3 sets of exams. You can only write a set a year, and usually a lot of people require 4 or 5 years to get through the program. And then we have the accounting designations. Some of the most famous ones for Canada now are listed on the slide. The CPA, the CGA, the ACCA is a global accounting designation. It is one of those designations which is historical, traditional, and probably the biggest in the world, in the sense that it is present in the entire world, but it is still based in the UK. Okay, so we have gone through lots of stuff about investments, just to try to give you a brief overview. Next time we will go into stock markets. Thank you very much.